And it seems like CTAs will do well in a rising rate environment.
I agree that with the rising interest rate market, we should do very well. What's happening right now is we're in a transitional period from falling interest rates for years. CTAs have done very well. When that transitions to to rising interest rates, there's a whole transition that has to take place where we're going to be trading our positions, getting out of what we're in and transitioning into a different perspective. The key to a CTA, though, is we can go short just as easily as we can go long, which makes our type of investment structure good for the long haul. Just like Fabian was saying, once this transition happens, we will be set up to make money during that period of time.
So certainly better position than a long-only vehicle.
Well, not only that, but it also goes to point out the timing. Most people in the financial industry, they look at different types of investment vehicles with the idea that they can time them and buy in at a bottom or a good time and then ride it and then sell at the high. A CTA isn't a type of vehicle that you can really time your investment. I mean, each of us have been running CTA firms for a long time, and trust me, I don't know about these guys, but we have our own money in there with us, and we can't time it. Now, if we can't time it, I don't know how anybody outside the industry is going to be able to time it. So the important thing is to get an allocation to CTAs, maintain that allocation. When you have other investments that are doing quite well, you can peel money off, put it into CTAs and vice versa. But I think over the long haul, it's a great environment for CTAs.
Absolutely a buy and hold strategy.
Oh, yeah, for sure. All of these different sectors work in combination. So the effects of one sector is going to affect the rest of the sectors. And the fact that we have a diversity across all of these sectors, it makes for a more robust investment strategy.
So risk is a key point.
I think it's a key point in systematic trading. I mean, we're all here very focused on the risk that we allocate to the portfolio, not only to individual markets, but also the portfolio as a whole. And we're looking at that every day. I think the other key thing about the divergence is what it's done to our industry, because we were seeing this, these markets that were very correlated from the financial crisis on. Everything was acting the same way. This divergence that has come up has meant the markets have become decorrelated, which gives us a lot more opportunities to make money, which I think attributes a lot to what happened in 2014.
Let me actually pull up a chart that I think will help illustrate that. So here you could see the New Edge CTA index in white. And this is the S&P here in yellow. This is going across the past 10 years. So, you know, 08 is a great point, lack of correlation between CTAs, and you can see the S&P is down at, you know, right between 08 and 09. But walk us through that. What do you see there, continuing with your thread of thought?
Well, I think what you see is leading into 2008, there was a lot of emphasis on alternative investments, but not so much on CTAs. So everybody was allocating to hedge funds and every type of alternative they could find. And then you had the crisis of 2008. And what happened is all these alternative investments became very correlated, all to the downside. So alternative investments that had no correlation to equities or very little correlation to equities, and if you actually go back and look at the numbers, there was correlation to equities. But you know, people thought they were getting hedges. Right. The reality was when a crisis happens, they all act exactly the same way, except for CTAs. You know, everybody has a theory. My theory is that CTAs can go short with just as easily as long with no additional costs. And that was a heck of a trend. We all picked up on it, and we all did very well during that period of time. This is the risk protection that everybody should want.
And this is an interesting point about correlation. Alternatives are supposed to be less correlated than, say, other asset classes to the markets. But even with alternatives, these are the less correlated. Is there anything that's, I mean, timber, real assets? What's less correlated than CTAs? Anything?
You can't be less correlated than basically zero.
Right.
So the only other direction you can go is to be negatively correlated. And negatively correlated is saying that if equities are making money, you're going to lose money. And I don't think there's much of a market out there for that type of strategy. So zero is the ultimate. Well, I think a black box is basically saying that if the data goes in, what comes out the other side, you don't know why it made the choices you made. I mean, all the computer technology that we use is nothing more than a tool. We know we could do the calculations by hand and come up with the same answers. We just use that to do it quicker and easier. But you're exactly right. We know exactly why we have the positions we have. I mean, you just run the numbers, crunch the numbers, and that tells you why you got a long position, why you have a certain number of contracts on. It's all about risk management and the strategy, choosing whether to be long or short.
And I want to go back to trend following. You mentioned you follow a midterm 2 to 3 month time horizon. Is that pretty across the board? Are you guys all following around that time horizon, or no, Marty?
We're longer term.
What is longer term exactly?
Well, right now it's like 6 months holding period. Our strategy has the ability to move between longer and shorter terms, and we are constantly gravitating. After the crisis, we gravitated to a fairly long term, and we've been peeling back slowly, but very gradually. And I think it's helped us because we haven't gotten caught in a few transitional periods that turned out to be a fake, and then the markets continued. So we've done fairly well since the crisis throughout, and I think it's just because we're one of the few that really have a long-term view, but we are moving shorter.
People are looking at liquidity across the board as an issue now. The fact that CTAs, all of their underlying investments are highly liquid, that's got to be attractive to investors.
CTAs is almost like the perfect world for an investor. You got total transparency. An investor has a managed account. They see every position that's on. They can value it every single day at a moment's time notice. Every day on the close, there's a settlement. You can close out the position within minutes. I mean, what else does an investor want? You got total liquidity, total transparency. I mean, it's kind of the perfect world.
It's ticking all the boxes.
Yeah. The other thing is, and I agree, that you got to be patient in this type of strategy. But if you're building an efficient portfolio, you want that non-correlation, whether it's working or not, because it reduces your risk in that portfolio. Over the long term, your risk-adjusted returns are going to be much better.
And would the addition push out your efficient frontier up and to the left with the addition of CTAs?
Absolutely. I mean, our studies show that first off, you got to allocate it based on risk, not based on AUM. So you want to look, because different CTAs trade at different volatilities, different risk. And our belief is that if you put 20% of your risk into CTA strategies, that's going to give you the most efficient portfolio balancing.
And you suggested around a 15% allocation.
Yeah, I mean, we've told people if you're not going to commit at least 5%, there's no point.
No point unless it's 5%. Okay.
I mean, this is an investment industry that they don't have knowledge about. So they have to get educated. It's going to be a lot of work managing the account. What's the point if you're not actually buying any insurance?
Right. It has to be a meaningful amount, to your point.
Yeah.
And what about these, new wrappers like 40 Act funds and UCITS? What are you seeing there?
I think it's great to make this available to as many people as possible. I mean, CTAs have always been considered on the fringes. Only the sophisticated investor should get involved. But there's a benefit to everybody. Now, the 40 Act space or UCITS, we actually have a UCIT. It's done very well. I actually agree that the retail investor tends to be maybe a little better at holding a position than the institutional. Institutions are great about talking about that they're not going to chase the dog's tail. They're all long-term, they're never chasing performance, and every time you turn around, they buy at the highs and sell at the lows. It's a given.
They like to say they're sticky money.
It's human nature, and that's the problem. The emotions get involved, and we avoid that because of the systematic nature that we trade. There's a lot of times I'm sure that we're sitting in our offices taking a trade that we just think is not a good trade. And it turns out to be a big winner.
Marty, your takeaways?
I think it's really amazing considering all the advantages that this industry has that it's as small as it is. And I think that is our fault as an industry from the education of the investor. And I think the biggest takeaway I can get is that programs like this that will educate the investors and the public about what we do and the advantages of managed futures is going to be a big benefit to this industry.
So education.
It's all about education.